Good evening. Uh, Thank you, Pushpu. Good evening, friends. Welcome to another edition of Finsherpa's Market Outlook, where we try and understand what is happening around us and the prospects for equity markets and so on. And today we have an expert to kind of take us through, unravel the mysteries of what's happening around the world and why our investments are behaving the way they are investing. So that's really what we're going to learn. And why is it important? It's even more important now than ever before, because we have two large events that face us. One is there is a conflict in the form of Ukraine and Russia that's happening concurrently. Also, we have the scenario that there is inflation around the world and interest rates are likely to move up. Now, both these present significant threats to equity markets. But what we have seen over the last few weeks is that equity markets did correct a bit, but we have seen some extraordinary inflows that have countered a significant slippage in the market. So to help us navigate what's happening in this space, we have an extremely important guest in the form of Atul Bhole, and it's my pleasure to introduce Atul Bhole to all of us. Atul Bhole is somebody who has joined the DSP Mutual Fund from May 2018 as the Vice President Investments. He has over 10 years prior experience working with the Tata Mutual Fund in various capacities. And prior to that, he's also worked with the JP Morgan Services as well as State Bank of India in equity research analysts. Atul has a degree in management from Jamnalal Bajaj Institute of Management, Mumbai, and is also a chartered accountant. For DSP, Atul manages the very, very successful, very, very sought after dynamic asset allocation fund, which is one of the best in the industry, and the DSP equity fund and the DSP equity and bond fund, an equally good hybrid fund in the industry with a long track record. So Atul manages all these funds, and today he's going to share with us some of his perspectives on the market based on what he thinks they are. With those words, I'd like to stop here and over to you, Atul. And we're very, very happy to have you in our midst today. Thank you so much.
Thank you, Krishnamurthy sir, and good evening, everybody. And thanks for joining on this call. So as sir said, I will try to talk about the macro, though there is so much uncertainty that it's very difficult to talk about any sort of confidence on this macro, particularly after the war has started. I mean, before that, I was pretty clear about how things can go, which way the things will go, etc. But particularly after the war has started, and at the start of the war also, nobody expected that it will continue for so long. I mean, people thought that Russia is too powerful and Ukraine will sort of give away maybe in 5-10 days, but it is still continuing. So I think beyond the point now, there is no point in looking at the war and how it will, when it will end, etc. The other thing which has assumed more importance now because of this war is basically the sanctions on Russia and the supply chain issues which has again erupted worldwide because of the sanctions, etc. So we are facing a lot of problems in last 2 years since the COVID outbreak, because there were a lot of supply chain issues because ports were closed, and then it was taking a lot of time for the supply chains to normalize. And then obviously there were other things like China curbing the pollution, etc. So that had impact on commodities. And now with this war, because Russia is a big supplier of sort of commodities, oil, gas, coal, etc., and also other precious metals like palladium, basically the metals which go into the newer supply chains like electric vehicles or batteries, etc., cobalt, nickel, palladium, that has also got impacted, and we are seeing that impact of those issues on the commodity prices. So commodity prices, including oil, has gone to record highs. So that is actually the bigger problem that than the war itself now for the global economy, as well as particularly for Indian economy also. And the linkages all of us know, because we import most of the commodities including oil. So, and that impacts us. So I think this is a new worry for us. And as I said, I mean, there's no point on worrying about the war when it will end. I hope it doesn't get escalated, and there are fears of chemical weapon and all those things. But I think hopefully it shouldn't go that way. But the commodity inflation is for real, and I think nobody has a clue when it will sort of commodity prices will sort of when it will come down, because historically, whenever US has imposed sanction on any country, they have not revoked those sanctions immediately. So, and the interesting point in this whole scenario or any of the geographical issues, what we are seeing is actually US doesn't get impacted so much. Actually, US sits in a corner of the world, and they are trying to sort of uh, manage the entire affair of the world, but the other countries or other economies get impacted. So right now, because of the sanction, Russia is obviously getting impacted, but along with Russia, Europe is the biggest loser in this whole game, because they get 55% of gas from Russia, and they get like 35% of oil from Russia, and they're not getting that, and obviously they are paying hefty prices for that oil as well as gas. So actually, Europe is the most impacted economy, and obviously it will have impact on the global economy. Uh, so that is a big problem now, and hence it is very difficult to sort of say anything how things will normalize when commodity prices will come down, and how the demand will shape up, because so much inflation is there. Obviously it will start hitting the purchasing power of people, because a lot of money will go on spending on fuel or the energy cost. I mean, the uh, utility, the power cost as well as transportation fuel cost in Europe has gone up multifold. So it will have impact on demand, and obviously then because of the global linkages, it actually spreads everywhere. So that is one. Secondly, there were and there are sort of fears about the US rate hikes, and the Fed actually made it clear in the December meeting only, December 21 meeting only, and now actually they have started. But to my mind, and I have mentioned in many calls also in last one and a half year, that uh, I don't see US Fed raising rate is a big problem for the market. Uh, First of all, it is a widely discussed issue. So market is sort of in a way position for that. So whatever hits the market uh, out of a blue, that becomes a problem. But anything which is known to the market, it starts getting factored slowly, and people are position themselves accordingly. So this Fed hike and as well as tapering, that was getting discussed for last one and a half years. So I think that is not going to be a problem. The other thing about the rate hike is basically they are worrying about inflation rightfully, and the large part of the inflation is because of the supply side problems. But some part of inflation is also because of the growth coming back. Now we all know what Fed has done for last 10-12 years in US since the global financial crisis. They have run a very easy monetary policy. They reduced the rate, they printed money, and during COVID, the government also uh, sort of uh, uh, sort of entered into this game by giving huge fiscal stimulus. They have given paychecks, and they have also announced the infrastructure package and all. So that is that has started a growth sort of revival in US as well as globally. So we are seeing the unemployment rate in US is at the lowest, housing starts at the highest, and overall economy is sort of picking up along with the opening of the economy also. So as long as the rate hike cycle is happening because of inflation, and when the inflation is happening because of growth, I think that is not so bad for the equity market, because ultimately market likes growth, and we are looking at growth revival. Obviously this war suddenly has come as a big negative surprise, but I think nonetheless, at least in US, the growth will continue even with the commodity shocks. So I was not reading the rate hikes very negatively, and still I don't read the rate hikes very negatively. If they have to happen, they will happen. But I think the point is, it they are supposed to happen because the growth is coming back, and obviously central banks don't want inflation to go out of hand, so they will start the rate hikes at any point of time. So I think globally these are the issues. The third issue is again goes back to the supply chain, because there is the outbreak of what do you call delta cron in China. I mean, there are delta patients have, and as well as omicron virus patients coming in China, and they have gone for again some strict lockdowns in certain port cities and manufacturing centers. So that will again impact the global manufacturing or the global supply chains. And uh, if I mean, there are linkages like we have seen last 1.5 year. If the chips are not available, the global automobile manufacturer gets suffered. So we have to see what will happen, because there are one or two port cities and manufacturing cities are under lockdown in China. How the what they are manufacturing and how it will impact the supply chain. So that is a third worry. So I think for me, the bigger worry is the commodity inflation and the supply chain disturbance, as because of war, as well as this Chinese this COVID outbreak again. I don't see US rate hikes as a big negative. I think that is okay. That is factored in by the market. Now coming to India, I think again, as I said, uh, obviously oil going to 120 and staying at 120 is negative for India. And obvious commodities are also gone up, so we will see problems. But the good part, compared to say 2000, say 2009, 10, 12, the our macro stability is ensured because of the reforms. So government has started doing this complete pass through of oil prices, and hence we have seen the petrol and diesel prices going to 90 and 105 in some states. uh, there is complete pass through of oil prices, and hence the government fiscal deficit doesn't get impacted like earlier, because whenever earlier oil started going up beyond 60, $70, because of the controlled nature of petrol diesel prices, government subsidies used to balloon, and obviously the fiscal deficit used to increase. But it is not happening this time. uh, Also, the second deficit, the current account deficit, which have impact on the rupee, etc. There also oil is not impacting us very badly this time, because we have reduced the electronics imports significantly in last 8, 10 years, because we have implemented this import substitution policy, increase import duties on many electronic items. We have gone for this productivity linked incentive scheme. So actually the electronic import has come down drastically, and actually we have started exporting even mobiles. So we export like 20, $25 billion of worth of mobile now. Also, the IT services export has picked up, and over a period of last 10, 15 years, and it has become like now 170, $180 billion of worth of exports. So because of these two things, our oil import bill, though it is going up, it is not impacting the CAD, the current account deficit, very negatively, and hence we are seeing INR stability. So despite oil going to 120, we are seeing more or less stable yields, as well as more or less stable rupee. So and that is because of the this reform of pass through of oil through petrol and diesel prices. So macro stability is ensured. The other problem is, because of petrol and diesel prices going up, obviously the purchasing power of people will come under question. Inflation will start going up. So that is, I think, uh, uh, that is a challenge. But I think it is a this is a better way to handle oil prices, to sort of focus on macro stability rather than uh, the purchasing power getting impacted for some period of time, I think. And that's why we are seeing even markets have also bounced back from the initial sell down. uh, so macro stability is more important from market angle rather than this temporary purchasing power, inflation, these kind of things. Uh, at some point of time, RBI will also start raising rate because of inflation, and the global central banks are raising rates. but I think we are still in a much better place compared to many other countries. So actually, out of COVID, India came out very well, and I think out of this war also, Indian economy will come out very well compared to many other economies in the world, and hence I remain bullish on Indian markets from long term, even medium term perspective. Obviously, we will have challenge for next 6-12 months. We will see earning cut going forward, earning downgrades, because raw material prices are going up, and companies obviously will not be able to pass on immediately. So there will be margin impact. Margins will come under pressure, and hence we will have earning cut. But I think that will be temporary. That will happen for the financial year of FY23, the next year. But I think hopefully, if the situation normalizes by then, FY24 earnings are not at risk, and markets are always forward-looking, and hence I don't think a big sell-off in the market, unless, I mean, there is a use of some chemical weapon or nuclear weapon. Those kind of things, obviously, nobody can predict. But I don't see a big sell-off in the market. Whatever has happened has happened. Unfortunately, it is not good. But I think there is no point in extrapolating things like commodity prices has gone up. So typically there is a human tendency, and we have seen that when oil went from 80 to 100 to 120, people are predicting 150 oil. Or when the aluminum went from $2,500 a ton to 2,800 and 2,500, people are saying it will go to 4,000. I think in such situation, in such kind of one-off events, uh, actually, behaviorally, one should look at uh, uh, one should not extrapolate these commodity prices, and one should actually start taking a contra view at some point of time. And I think that is the situation we are in, and I'm doing the same in my portfolio. I think uh, hopefully the situation will de-escalate. Commodity prices will also come down, because there is a lot of financials are also in hedge funds, etc., involved. So the way commodities has gone up, I would say that the probability of commodities coming down is also significant. So hence, it is better to uh, take a contra view in such kind of situation, and invest into stocks of your liking, uh, which are getting impacted currently. But if the things reverses, they will start again benefiting. So that is the view I'm taking in the portfolio. uh, Lastly, on the FII selling point, because that is again a topical point, people are worried about FII selling and all. So from financial year starting April 2021, since that date, FIIs has sold $28 billion of Indian equities in the secondary market. So that is approximately like 1,70,000 crore. Out of that, they had put in some money into these new age IPOs like Paytm, PB Fintech, and burned their hands. But they have sold $28 billion till that. And the good part of it, we have absorbed all this selling. So as I mentioned, oil doesn't impact us as it used to be 2014, pre 2014. I think the FII selling is also not impacting us like it used to be before 2014. So the flows into the market are significant, and thanks to all of you, and I think they will remain that way. I don't see, even if market staying range bound, the flows will sort of come down. The thing is, Indian household financial savings are around $700 billion. At the current rate of 12-15,000 per month in the equity market, people are investing 20-25 billion out of this $700 billion into Indian equity market. That is just 5% into the mutual funds. They may be investing through directly insurance, etc., but the proportion is still very low. This 5% of annual household financial savings into mutual fund, in developed market, the proportion is 40-50%. So we have a long way to go, and I think this culture has picked up. Uh, if you if you look at how the US has progressed in 1960s and 70s, they started this 401k movement, like the retirement money started to come into equity markets and all. I think we are going through that phase, and in many aspects, actually, Indian economy is like 60s, 70s US economy, where where consumerism is increasing, the quick service restaurant, this Domino's and pizzas, and those are getting set up, and all those things are happening. So I think we have a long way to go, and hence I think FIS flows, outflows also is not a worry for us now. And I would say uh, uh, we have checked in the history that how long FIS has sold and how big they have sold. So during tapering of 2013, FIS has sold like 2.5-3% of the market cap, then market cap, and currently also they had sold around that level. So and from those levels, typically they start buyers. And other thing is, from emerging market, typically FIs start selling or keep on selling till the interest rate start rising. And once the interest rate start rising, the typically the selling subsides. I mean, before interest rate rise, they try to get the money out of this emerging market. But actually, once the rate hike cycle starts, everything gets into price, and then they again start pouring money. So again, these are historical evidences, but I'm not saying that they will start investing tomorrow, but I think last part of the selling is probably over. Their India weight is coming down, and hence the flows can come back. And even if it doesn't come back, I don't worry about that. So that is on the macro side. Uh, on India, many other, actually, I am very positive on the Indian economy first because macro stability is ensured in terms of fiscal deficit and current account deficit. We are seeing record tax collection in terms of GST as well as direct and indirect tax, and that will put government in a very good shape in terms of their ability to spend, etc. Uh, we are not seeing private sector capex cycle yet, but we are seeing that at least at the sectoral levels, like cement sector utilization, and they have started putting up announcing capex plans. Even steel companies have started announcing capex plan. Uh, so those sort of things have started. The PLI link capex is there, is about to start. So a bit of private capex will also start. Uh, I think employment-wise, India is getting into a good shape. I know because of COVID, lot of informal sector job losses have started. But I mean, you would be reading these numbers of EPFO subscriber going up and all. So I think a lot of enterprises are getting registered, and a lot of employment is also happening or the increasing. Like in IT sector itself, and you will be better knowing this because you are from the south part of the country. IT companies are going to hire record number of freshers this year, and the salaries are also going up significantly. Attrition is running at 20%, so companies are giving like 30, 40, 50% pay hikes to people. The PLI link incentive scheme is forcing companies to start the capex and start manufacturing, and those companies will also have to hire big number of people. Exports in textiles are doing well. So I think the manufacturing as well as IT related employment is on the rise. Uh, Real estate, personally, I think we are already started the real estate cycle. Real estate didn't do well for last 10 years, but I think post COVID, because of whatever inflection we have seen, I think we will see real estate picking up. The salaries has gone up, but real estate prices are stagnant for last 5-10 years. Interest rates are at record low. There is tremendous competition amongst banks and NBFCs and HFCs to give mortgages or housing loans. So we are seeing some start of the launches of the projects and the sales happening, volumes happening. So, and real estate is a big employment sector, generating sector, because 10-20 other sectors depend on real estate, like furnishings and electricals and ceramic tiles and all those things. So I think employment wise, we are getting into a good situation from the worst we have seen in the COVID. So I think Indian economy will bounce back very sharply, like it did in 2021 after COVID. Uh, 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 Obviously, we have to keep the finger crossed because of these commodity prices. They have to correct, and I will take a positive view on that rather than taking a negative view, because historically we have seen that people extrapolate. When the oil went to 20, 40, people said it will go to 20, and when it went to 120, people are saying it will go to 150. I think that is not the case. Things actually mean reverts after some time, and I will play for that. Coming to the portfolio, uh, Actually, the fund has underperformed. All my three funds have underperformed in last 6 months. Obviously, 3 5 years, the performance is still very good. But last 3 6 months, our funds have underperformed because of the uh, purely because of the style or the framework I follow. So I typically invest into 80% of my portfolio into quality companies which are growing, and so I look at good business like, I mean, there are stocks in the portfolio like Asian Paint or Bajaj Finance or Ultratech Cement, etc. So business has to be good in terms of cash generation, less capex and moats and what those typical things. Management has to be good and growth has to be there. So I typically invest into such stocks. Uh, and I generally don't like companies which are very capex oriented, which are very cyclical, where government interference or government policy impacts the businesses a lot, where managements are not up to the mark, or where I can't sort of build confidence on those managements. I stay away from those stocks. And because of this kind of framework or thought process, I generally end up investing into most of the quality companies from the consumer side, like as I mentioned, Asian Paint, Havels, or this kind of companies. And I generally end up avoiding companies coming out from metal sector or power sector or oil and gas, or mostly PSU. I don't invest. Public sector enterprise, government companies, I don't invest. In last 3 6 months, because of the situation which has developed, uh, my companies or the holdings got impacted. These companies actually made a lifetime high share prices during Diwali or before Diwali, and after that situation changed. Commodity prices have started going up, which is not good for them. They have pricing power and they will pass on the raw material hike, but it happens with 1 2 quarter lag, and it is happening. But nonetheless, the stock prices corrected from those record levels. On the other side, the stocks where I'm not invested or doesn't generally invest, like oil companies or metal companies or power companies, some of them did very well, and that is sort of a double whammy we had in the portfolio. So last 3 6 months is not looking good, but I'm not changing the positioning at all because of this. As I said, there is no point in sort of chasing the momentum which is happening on the metal side or the power side or those kind of stocks, because things mean revert, and then the stock prices will also mean revert that way. Actually, within this my core competence, like B2C companies or quality companies, wherever there is correction, I'm adding to the same companies, or wherever I wanted to add but because of valuation I couldn't add, I am adding those companies, new companies in my portfolio in this correction. Positioning wise, I continue to remain very bullish and overweight on private banks and certain NBFCs, and even some of the insurance companies. Insurance company call didn't work for last 1 year, but I think those companies are very good and they will do well. Generally, the banking and insurance call at the industry level also didn't work for many people because because of FII selling, and because FIIs are selling heavily and generally they own banking sector in India. There we are seeing the very high selling pressure. But I think that is purely a technical factor and not fundamental. Fundamentally, these banks are doing fantastically very well, and hence I think they will make a comeback when situation improves. So I am actually holding on to what I have, or actually increasing selectively in this bucket. Uh, Secondly, I went overweight on auto. Last 2 3 years I was underweight, but I found the prices very well. The price levels at attractive prices at attractive levels. So I started adding to the auto stocks. I think they were getting impacted because of low demand, because of COVID and all those things. Last year there was chip shortage issues, so they couldn't make those cars and etc. But I think the now the situation should improve for all these companies. There is pent up demand of last 3 4 years. The inflation which hits certain low end products like say two wheelers or etc doesn't hit so much the cars or etc, because the purchaser profile is completely different. They are buying a 6 lakh car. If the price goes to 6 lakh 50,000, it doesn't impact so much to those people, and they don't sort of change their uh, decision of buying decision. So I think passenger vehicle I'm pretty bullish, and hence I added those stocks in the portfolio. I think the model uh, launch cycle is also starting for those companies, and whenever auto companies the new model cycle starts, those companies do very well, end up doing very well. So I increase my auto sector exposure. I am overweight on cement and continuing with that overweight. Cement sector also got impacted because cement is heavily dependent on coal as well as oil, and both these prices has gone up, and hence the stocks have corrected significantly in last 2 months. But I think at the stocks I have, I'm very bullish on those stocks, the companies, what they are doing on ground, and uh, I'm very bullish on the infrastructure and real estate, etc. And I think to play that, cement is the best proxy. So I will again sort of selectively increase my exposure into those stocks also. Uh, Lastly, I was underweight on IT, but I increased my exposure to IT also, because though I said rupee is not depreciating and it is behaving very well, but globally IT spends are continuing to be very strong. These companies have started getting price hikes, because lot of work was getting done through areas of Ukraine, Poland, Belarus, and those kind of areas. Though the number of developers are very little compared to Indian developers, the quantity we have. But because those companies are finding it difficult to deliver, I think the pricing power is coming back. So it will help us in short term as well as in long term also. It can help because vendors will again try to de-risk their business model. So the clients will try to de-risk their business model, and work can come to us. And also, if the oil remains at these levels, etc., and because US has started to increase the rates, our rupee can depreciate in a narrow range, which will be again positive for IT companies. And anyway, in this kind of volatile environment, people go looking for defensive sectors and stocks. So hence I increase my IT exposure in this whole episode of war. So that is also pharma and chemicals. I am neutral to overweight. I think those companies will do very well. So this is the overweight sectors I have in the portfolio. I am also overweight on consumption sector, as I started saying that I like companies where businesses are good, managements are good and growing. So I am overweight on certain sectors like cable and wire companies, plywood companies, retailing companies, etc., etc. So this is basically bottom up stock selection, and I think those companies are doing in their subsectors, they are doing very well, getting market share from the unorganized players, because life is getting difficult for the unorganized players since demonetization. So these companies are doing very well. So there I have invested a good chunk of the portfolio. In terms of underweight, I have no holding in metal stock. I have no holding in oil space. I have certain gas stocks. Uh, I don't own any power utility company. Uh, uh, so uh, that is the way portfolio is structured in terms of sectors. In terms of large cap, mid cap, I generally keep 60% large cap and 60-65% large cap and 30-35% mid cap. Currently, it is on the 38% is mid and small cap, and I think I will broadly maintain this kind of range, rather than taking a call and large and mid cap and all, I will focus on stock selection, because I mean the starting point is whether a company is a good company or a bad company for me, or a good business or a bad business, rather than looking at the market capitalization. So I think I will maintain this mix, and I'm not taking any cash call or market call. I mean, I think first of all, I'm not that bearish on the market, and secondly, when investors have taken a call to invest in the market, so I will not further sort of take a cash call and complicate that call taken by the investors or the advisors like you. So no cash call, 60-40% large and mid cap mix, and generally I will have 60-65 stocks in the portfolio, whereby I can manage the risk return in a much better way. So this is the way I run the portfolio, and this is my thinking on the markets. And I think I have taken slightly more than 30 minutes, but I will stop here, and I can take questions. I'll be happy to answer those questions.
Atul, hi, this is Sridhar from Finsherpa.
Yeah, Sridhar.
Hey, first of all, not only for Atul, for everyone who are participating here, thanks a lot for joining with us. And Babu Krishnamurthy right now is not in the call. He's having an unscheduled, no, but at the same time, very urgent kind of call meeting. So he has just left. I hope he also would have shared this info to Viju. Okay. And many thanks to Atul because you have taken us through a very nice way of starting with the market outlook, then your own funds, the three fund schemes that you are managing. And especially we are very, as an advisor, we are very much, happy to see the dynamic asset allocation you are fund that's extremely, you have taken it up. And I have one small question as an advisor. At the same time, I used to encounter this kind of queries from my customers also. Is that suppose generally because this kind of market outlook we used to done it monthly once, where Babu himself will do it. This time, it's a bonus because it has come through harsh mouth. So Atul Bhole, you please share one thing. Like I have money, so I am asking you. You are managing three schemes. So can you please prioritize which schemes you invest out of my money?
Okay. So yeah, right. So generally, obviously, the allocation. I mean, I need not tell you. It will depend on the investor's appetite, his age, and his goals, etc. All those things. But
Right.
if you just generally look at from the market perspective, and if the money is completely discretionary, I mean, he don't
Yeah.
want it for next 5 years or 4 years, etc. I will actually put it in the flexi cap fund.
Okay.
See,
Fine.
because I think one thing is clear that the rates are going to go up on the fixed income side.
Right.
Yeah. Uh, and on the market side, I think though we have this temporary difficulty in terms of commodity prices and war and all, but on the Indian economy, whatever I see and read and the reforms we had, I think we are going to see huge benefit of those reforms in next 2, 3, 4 years. Like previously we had seen that before this golden quadrilateral and all those things happened during 1999 to 2004, and the benefit of that actually came to us from 2005 to 2010 period. So
Hmm.
lot of things have happened in last 5, 6 years, particularly on the manufacturing sector, in terms of they have put lot of import duties. So the manufacturing has started in India. They have come out with this productivity link incentive scheme. So a lot of manufacturing is going to start in India, and it will obviously help us in creating jobs and well-paying jobs. So I think from that perspective, I'm very positive. And secondly, from the macro stability perspective, I'm coming to this point again and again because earlier India was put into a bucket of fragile five and all those things because of the oil going up. Our
Okay.
fiscal deficit used to come under trouble. Our current account, a rupee used to
You told that,
depreciate
yeah.
5-10%. That is not the case anymore. So I am very, very bullish from the economic perspective. On individual businesses, individual company side, we are facing temporary problems because they will see margin pressure of aluminum, steel, copper, whatever. But I think that is temporary 3, 6 months scenario. So I would go with at least if it is my money, I will go with the 100% equity.
You could the flexi cap. I mean,
Flexi cap, yeah.
that was my specifics. Yeah. Like Atul, I know. Can you also very briefly, very briefly, because just share that side. I mean, in terms of you spoke, and you were very clear about bullish in terms of equity and Indian markets. But very briefly, can you throw light on because the customers, what we have, they invest in both asset classes. Also, commodity, of course, you have shared, but then specifically gold, very briefly in these 2 points.
Yeah.
Your call.
Yeah. Correct. So I think most of the commodities which are like industrial commodities, I think they should pull off, including oil, copper, aluminum, etc. They should pull off. There are supply side challenges, but whenever commodities go to such extreme highs, the demand destruction starts happening. Like I mean, people won't make many cars at 3600 aluminum per ton because the cost will go up, and at certain level, demand destruction starts. So it's the auto balancing mechanism which works in economics. So I think that's why I said there is no point in extrapolating the commodity prices. I mean,
Right.
I don't know when they will come down, but they should not go up from here. That's my personal view. I may go wrong, but
Right.
that is one. But on gold, I'm very positive because generally gold does well when there is inflation and there is war, and now we have both. So uh, uh, and gold has not done well in since the start of this year. I mean, from 1800, I mean, in Indian terms, from like 48,000, it has just gone to 53,000 or something like that. So it is not actually enough. So gold, I think, has a lot of leg to go up. Probably what is distorting the picture this time is a lot of money is is going into these cryptocurrencies and bitcoins and all. So probably that is distorting the gold movement. But I think the other thing which is happening is basically uh, countries like China, Russia, they are sort of trying to do trade without using dollar. Like China is talking to Saudi in terms of buying oil and paying in their currency renminbi. Russia is also trying to sell us dollar in exchange of rupees. So if the dollar as a currency of the world is that confidence is getting shaken, or the countries are trying to sort of uh, uh, disassociate with dollar and all, obviously gold will sort of shine. So I think I'm very positive on
Okay.
gold, and hence some allocation. Like anyways, Indian households have a lot of gold, jewelry and all. But I think some part of financial asset, 5-10% maybe, should be invested into gold ETFs, gold funds, etc., etc.
Right. Thank you. Thank you.
Yeah, thanks.
I mean, yeah, thanks, Atul. Any other questions? I mean, within Finsherpa team as well as our clients, beloved clients. Any other questions, queries, please? Because the fund manager is available right now with us.
Yeah. My name is Ramdas. Thank you, Mr. Sridhar.
Yes,
with your permission, I have
Please.
one question to Mr.
Atul.
Bhole.
Mr. Atul.
Yeah, Mr. Atulbhole. Yes.
Yes, sir.
It's like this. Would you? I mean, you made this point about Europe being not in a good situation because of the the war and the dependence of Europe on Russian energy sources. So, would you would you therefore? Because eventually, I think because of NATO, this is my perspective, I could be wrong, but because of NATO and the way Europe and the US are reacting to Russia's invasion of Ukraine, I don't think the war will spread beyond Ukraine, and therefore, to that extent, I think Europe would be stable, even though they are economically badly hit by what's happening in the war, and therefore, probably the markets are doing badly in Europe. So, is this a good time to invest in European, Europe-heavy funds?
Okay, so right, so it is a very good question. So things are not good, and hence stock markets are not doing well there. And obviously, as I mentioned, at some points we have to take contra calls as well to make money from the oversold or over depressed level. So that may be true in case of Europe. But the point about Europe is, even before the start of the war, if you look at last 10 years, 15 years, the demographics of Europe is not very good in terms of the working population. I mean, most of the population in Europe is like average age would be like 45, 50 years of age. The demand growth in Europe is not great. Like in India, our economy grows at whatever 5, 6, 7% depending on the environment. In Europe, the economy is growing at 1-2% only, and that is not going to change because the demographics, and they are developed countries. Most of them are developed countries. So I think even before this war, we are seeing Europe was struggling. We have seen, and most of the European governments are heavily indebted. I mean, we have seen the Portugal, Greece, and all those issues in 2013, 12, 13, 14, the pigs. They were on the verge of bankruptcy, and the other countries, strong countries like Germany, had to help them, etc. So I think that is the problem with European economy, and it is actually getting aggravated because of the war. I mean, their savings levels are low. They depend on the government sort of uh, uh, pensions or the social security, etc. And now the fuel cost going up for them significantly, so it will get impacted. The purchasing power will get impacted. Secondly, many of the European companies are also facing problems. Like Germany is a big automobile sort of hub, the BMW, Mercedes Benz, Volkswagen, etc. But now they are struggling with the uh, Tesla coming up with electric vehicles. Obviously, they will make a transition, but as of now, they are struggling and it is taking time. So, likewise, the hub of innovation has moved in. I mean, this is very long sort of period, but the hub of innovation has shifted from Europe to US in terms of we haven't seen any big company coming out of Europe like we have seen Apple, Amazon, Facebook coming out of US. So I think uh, we can take those kind of calls because the markets are oversold in Europe and things will normalize. But I think it will be sort of a trading call that you have to take. And anyway, I'm not sort of expert on European market, but it makes sense when the markets are oversold, things will normalize, things will recover. But that time, then you should be timely exit those markets as well.
Okay. All right. Thank you very much. I appreciate that very nice perspective. One other question I have, and this is with regard to India. I know that you are very optimistic, and that feels good, especially when we have a number of funds invested in India. The one worry that I have, and this is more from an anecdotal point of view, not based on really statistics, etc., is that anecdotally I find that, for example, middle class and upper middle class, I think, are finding inflation rates for the items that they consume to be much higher than the nominal inflation, CPI based inflation rate that the government publishes. So I can understand that at a worker level, etc., maybe they don't consume the kind of things that we do, but I find anecdotally that the inflation rate is very high right now.
Right.
And would that because and a lot of the like you said, FIIs exiting India has been compensated by a lot of individuals piling into the market. But would that kind of psychologically affect people saying, inflation rate is now so high, and I'm insecure about the money that I have, and therefore I should hold back from the market, and therefore the market gets depressed? That is one part of the question. The other is whether this inflation, this runaway inflation for the middle and upper middle class, whether that will result in stagflation, that is inflation on the one hand and stagnation of the economy on the other, and of course consequent problems with asset prices increasing, etc. So I don't know how this mix you see. I know that you're overall optimistic about the Indian market.
So yes, you are right that inflation is sort of pinching the common man. The purchasing power is getting impacted. But I always believe that in India we have many Indias. Like when one part of India is getting impacted, the other part is actually doing very well. That is unfortunate of part of income inequality, which has sort of again went up during COVID. Hence, we are seeing on the other side that stocks like Titan are hitting lifetime highs, and people are, buying jewelries, and there are waiting periods for car, like six months of waiting period for cars like Creta and Seltos and all those things. While on the other side, rural India is facing problem. The lower middle class is facing problem because of the inflation. So I think we cannot sort of generalize the thing. And secondly, the money coming into market, I think obviously it is coming from the affluent part of the society, or people, salaried people, which are not getting impacted so much because of this inflation. It is impacting people who are sort of daily wage earners or farmers or those kind of people are getting impacted. But even there, I think whenever this kind of inflation makes a comeback, we will obviously are going to see wage inflation and salary inflation coming into India. That is the second round impact of inflation, and that is the way it gets balanced. So I think we are going to see salary hikes. It has already happening in many jobs like IT sector and private sector, etc. It has started to happen, and it will happen even in the unorganized sector or even day-to-day workers like carpenters, masons, etc. I think there also we will see wages going up, and it will take care of the problems they are facing. So I think it is a self-correcting mechanism, and overall inflation is not as such a bad thing till it is remaining in a moderate level of say 4-5% inflation is not so bad for the economy, because when that kind of inflation is there, the income levels goes up in nominal terms. I mean, economics talk about in real terms, but common man is sort of looking at nominal growth. So when economy is growing at 6%, inflation is at 4-5%, obviously the nominal economy will go at 11-12%. So government tax collection also happens in nominal terms. Corporate top line grows in nominal terms. So whenever those things are there, the situation we have seen during the period of 2003 to 2007-8, probably we are getting into that kind of situation to some extent, and hence there will be temporary lead lag of inflation, wages, passing on of raw material prices, margin going down and coming up, etc. Those lead lags will be there over next 6-12 months, but I don't think it will derail the India story. I mean, stagflation kind of situation I don't expect for Indian economy.
Okay, thank you very much. I appreciate your answer.
Thank you, sir.
It is a question because we have another 5 minutes. Otherwise, we can. Atul, thanks a lot, Atul. It is extremely good because generally we used to hear from you people. Then we will have this session with our clients. This time you have come all the way, so that's a validation, extra additional.
Thank you, sir. Thanks for this opportunity, and thanks everybody for joining on the call.
Thank
Have
you.
a great weekend.
Great. Thank you very much. Thank you.
Thank you.
Thank you. Thank